Welcome back to the Ontario Mortgage and Real Estate Insights podcast. This is episode number 56, and I'm your host, Steve Hamoen. Today we're diving into some critical updates that affect all of us in the real estate and mortgage industry. From falling mortgage rates to the challenges in Toronto's condo market, we've got a lot to cover. So, let's get started. First up, let's talk about the recent dip in mortgage rates and what it means for housing affordability in Canada. According to a new analysis by the digital mortgage lender Nesto, cooling inflation and lower mortgage rates in recent weeks are offering a glimmer of hope for Canadian homeowners and buyers. But it's not all sunshine and rainbows just yet. Mortgage expert Samson Solomon wrote this week that another dip in overall inflation last month, from 2.7% to 2.5%, could result in a more stable economic future and lower mortgage rates. This trend could indicate that the Bank of Canada's efforts are starting to see results. And while it's a positive sign, the path to full economic recovery is still long and arduous. Potential low interest rates and further cuts are undoubtedly good news for Canadians burdened by high borrowing and housing costs. This prospect of lower interest rates could bring much-needed relief to Canadian homeowners facing rising mortgage costs. However, translating lower policy rates into lower mortgage rates might take some time, and the overall impact on housing affordability will likely be gradual. Similarly, affordability is still a concern, and the impact of any rate reductions on the housing market may take time to materialize. While the broader economic picture shows signs of improvement with easing inflation, the Canadian housing market remains a significant source of financial strain for many, Solomon wrote. Housing costs represent a substantial portion of household budgets, and unfortunately, these costs are still on the rise, particularly among renters. Still, that improving outlook on inflation means the Bank of Canada can now shift its focus towards addressing other critical economic issues, thanks to inflation seemingly being under control. For example, the labor market is showing signs of weakness, and developing job growth will be crucial for sustained economic recovery. Solomon noted that even though the July inflation report is positive, it should serve as a reminder that the economy is still in a delicate state. So, while there is a glimmer of hope with falling mortgage rates and cooling inflation, we still have a long way to go before we see a significant improvement in housing affordability. Next, let's dive into what's tanking Toronto's condo market. It has been a rough year for the sector, and the number of investors losing money is on the rise. According to a recent report by CIBC and Urbanation, a staggering 82% of new condo investors' mortgages were cash flow negative in the first half of 2024. This is a stark contrast to the years 2020 and 2021, when much lower interest rates helped owners turn a profit each month. The situation has worsened significantly since 2022, with the percentage of cash flow negative mortgages jumping by 30% due to higher borrowing costs and rising interest rates. This has led many to question whether there could be opportunities for new buyers in the city's condo market. Chris Bargis, a mortgage broker and team lead at Mortgage Edge, believes that the current landscape might present an opening for buyers hoping to take their first steps into the housing market. Government stimulus aimed at keeping struggling building projects afloat may arrive, but until then, there might be opportunities on new inventory in the coming months if we see price reductions. So, what's causing the recent panic in Toronto's condo market? A series of real estate insolvencies, particularly in new construction condo projects, over the past year has spooked the market and pushed many would-be investor buyers to the sidelines. Skyrocketing developer costs and labor wages have created fresh headaches for builders in the condo space. Bargis notes that as projects move further into development phases, the greatest cost to a builder is the interest on the construction loan. Due to the significant increase in construction costs, builders are forced to anticipate and incorporate these expenses into their projects. Unfortunately, people just are not willing to pay these inflated prices today. Urbanation's Sean Hildebrand and CIBC's Benjamin Tal, authors of the recent report, describe the current situation as an economic lockdown that makes little sense for either investors or developers. They point out that prices are too high for investors to buy relative to resale prices, rents, and interest rates. Meanwhile, developers cannot lower prices due to high development costs. As a result, new condo sales have plummeted to their lowest level since the late 1990s. This decline is significant because new condo sales are a primary driver of new home construction in Canada's largest market. The growing appetite of investors to list their units for sale is contributing to a record high number of condos currently on the market. However, this trend could spell bad news for renters facing a diminished supply of rental stock in Toronto. On a somewhat brighter note, 2 consecutive summer rate cuts by the Bank of Canada have helped boost consumer confidence and increased interest among potential buyers. Vargas mentions that there has been a noticeable uptick in inquiries from buyers who see these rate cuts as a sign that the central bank might be recognizing the unsustainability of a high interest rate environment. Fixed rates are likely to continue falling in the coming weeks and months, although the decline might not be in a straight line. Variable rate discounts could also decrease after the end of October, but this is not guaranteed. Recent economic tremors in the United States have led to expectations of a Federal Reserve interest rate cut in September, which should spur a decline in fixed rates in Canada as well. It will be interesting to see how all of this unfolds in the fourth quarter. The Toronto condo market is in a state of flux, and while challenges abound, there are also potential opportunities for savvy buyers. Overall, homebuilder sentiment on the construction outlook is continuing to worsen, with the Canadian Homebuilders Association revealing its Housing Market Index, or HMI, plunged yet again in 2024's second quarter. The negative outlook on new home sales suggests that housing starts, especially for homeownership, will not likely see a significant increase anytime soon. Housing market indices in Ontario and British Columbia have reached record lows, which is a cause for concern because these provinces face the greatest challenges in housing affordability while having the highest demand for more housing supply. Despite this, the full effects of the slowdown have yet to be felt in housing starts numbers because of long building timelines, especially for multifamily buildings. The HMI is a sentiment indicator that assesses current selling conditions, expectations for selling conditions over the next 6 months, and the level of sales office traffic or other measures of prospective buyer interest. This makes it a reliable predictor of housing starts 6 months or more into the future. In the second quarter of 2024, the single-family HMI had a score of 29.9 out of 100, 5 points lower than the previous quarter and 10 points lower than the same period last year. Similarly, the multifamily HMI for the second quarter of 2024 dropped to 32.5, down 5.4 points from the previous quarter and 8.5 points from the second quarter of 2023. The low HMI scores in Ontario and British Columbia reflect the high home prices and the difficulty buyers face in accessing mortgages. In these provinces, large urban centers suffer from high development taxes and municipal processes that hinder supply, exacerbating the housing supply deficit and driving up prices. As a result, 48% of HMI respondents said they are building fewer units than they normally would because of challenges with mortgage qualifications for their customers. And 22% have stated that lack of sales has led to the cancellation of projects. Overall, 61% of respondents expect to see only half the number of housing starts this year compared to 2023. Kevin Lee, Chief Executive Officer of the Canadian Homebuilders Association, commented that the slowly dropping interest rate environment is not enough to counter the restrictive mortgage rules, contributing to buyers' inability to enter the market with today's house prices. He emphasized that Canada continues to need both more supply and changes to mortgage rules to help drive the construction of that supply. If buyers cannot get better access to mortgages and municipalities do not lower development taxes and address the barriers to home building, the chronic undersupply of homes will only get worse in many areas of the country, which will drive up house prices again. Much more policy change is needed to turn the tides and get housing supply momentum underway. As of August 1st, first-time buyers of new construction homes can now access 30-year amortizations on insured mortgages. Lee mentioned that this is an important action to help the next generation of well-qualified individuals into the market. However, he also highlighted the need for more relief on the mortgage front, such as expanding 30-year amortizations on all insured mortgages for new construction. Lee also called for revisions to the mortgage stress test to make it dynamic and lower it at higher rates. Every level of government must tackle this problem from every angle, in concert. Let's shift gears and talk about some good news for a change. A recent survey conducted by Royal LePage and Hill and Knowlton has revealed that home buying optimism is high among young Canadians. According to the survey, an impressive 84% of Canadian adults in Generation Z and younger millennials, aged 18 to 38 and born between 1986 and 2006, consider homeownership a good investment. Among those who do not currently own a home, 74% see it as a priority and a significant milestone they're actively working towards. This is encouraging news for the future of the housing market, as it indicates a strong desire among younger generations to invest in real estate despite the high costs associated with it. However, the survey also highlights some of the challenges these young buyers face. While they are optimistic, only 54% believe homeownership is an attainable goal. 26% are uncertain, and 20% feel it is not achievable at all. These numbers reflect the ongoing affordability issues in the Canadian housing market. Phil Soper, President and CEO of Royal LePage, commented on the findings, saying, "It is not surprising that young buyer hopefuls see immense benefits in home ownership. What is both surprising and promising in these findings is the practical and purposeful manner in which these people are tackling affordability barriers. They are well educated on the state of the real estate market and the wide variety of government programs put in place to assist young families find homes." Soper went on to explain that many young Canadians are hyper-focused on saving for a down payment, which is often the biggest hurdle buyers face. They are also open to creative solutions, such as shared ownership with friends and family, or buying a property with the express intention of renting a portion of the home to a tenant. This level of resourcefulness is a positive sign for the future of homeownership in Canada. For many of these Canadians, the desire to own a home is driven by the need for long-term housing security. Nearly 73% of next-generation homebuyers who prioritize homeownership want a permanent place of their own, while 57% believe that owning a home offers stability. Additionally, 45% feel that renting is restrictive because of landlord policies, and 32% see homeownership as part of their retirement plan. These findings suggest that despite the challenges, young Canadians are highly motivated and are taking practical steps to overcome the barriers to home ownership. Their optimism and proactive approach could very well shape the future of the Canadian real estate market. In a significant legal development, the Ontario Court of Appeal has sided with First Source Mortgage Corporation in a dispute with real estate developer Michael Clausen over a $15.5 million loan for the 660 Sunningdale real estate project in London, Ontario. This ruling sets a precedent for lending protocols in the province, making it a landmark decision for the real estate and mortgage industry. The case revolved around the conditions of the loan, which Clausen argued were unfair and overly stringent. First Source Mortgage Corporation had imposed several conditions that Clausen claimed made it nearly impossible to meet the project's financial goals. However, the court found that the lender's conditions were within legal bounds and necessary to mitigate the financial risk involved in such a substantial loan. Judges at the Ontario Court of Appeal emphasized that the terms of the loan were clearly outlined in the contract, and that Clausen had agreed to these terms when he accepted the loan. The court's decision underscores the importance of due diligence and thorough understanding of loan agreements before entering into such contracts. This ruling is particularly important as it clarifies the legal expectations for both lenders and borrowers in the real estate sector. By siding with First Source Mortgage Corporation, the court has reinforced the notion that lenders have the right to impose conditions that protect their financial interests, provided these conditions are clearly stated in the loan agreement. For developers, this decision serves as a cautionary tale about the need for meticulous financial planning and legal consultation when negotiating loan terms. It also highlights the critical role of transparency and communication between lenders and borrowers to avoid such disputes. Overall, the court's decision is expected to have far-reaching implications for the real estate development industry in Ontario. It sets a legal benchmark that could influence future lending practices and real estate development projects across the province. And that wraps up today's episode of the Ontario Mortgage and Real Estate Insights podcast. From falling mortgage rates to the challenges in Toronto's condo market and now a landmark legal ruling, it's clear that the real estate landscape is ever changing. Stay tuned for more updates and insights in our next episode. Thanks for joining me, Steve Hamoan, and have a great day.